Hey guys, welcome back to this channel. Hope you have a wonderful day. If you guys new to this channel, we usually talk about a lot of things when it comes to
money.
If you guys new to this channel, don't forget to subscribe, comment guys, it will be muchly appreciated. In today's video, we're going to talk about the different type of asset. Some people get it confused between asset and liability, let's say.
Yeah.
When I first heard this, it was so confusing for me. And I'm like, I don't know if this is an asset, I don't know if this is a liability. But we're trying to make it simplified this for you. Especially if you're new to personal finance, investing, trying to create fire. Anything got to do when it comes to spending your money.
Or saving your money.
This might help you guys along the way. So
we're not accountant and we're not a financial advisor, so it's just in our terms. It's not in accounting firm, because in accounting terms it's different asset and liabilities.
So, and I think this is sort of gives me, when I started dive into this, it gives me a lot of understanding of how is my spending habits going to go. Because every time I do something, is this going to make me wealthier, or is this gonna make it go and see you later, bye-bye? So that's the reason why I started. That's how I see it. Every time I spend something, is this an asset or is this a liability? So I figured, let's go figure out which one is a good asset and a bad asset. So what's your definition of good asset or bad asset?
Well, I'll say we use a good asset and bad asset, not asset and liability. Because when you mention liability, is you owe someone money.
Let's just looking at
good one or bad one, right? So good for me. Good asset, cash. Right?
Now, what does it do? What does it physically do? Like, what is the definition? So my definition of an asset would be a good asset is actually creating you more income.
Yes.
Okay. A bad asset, obviously, it doesn't produce you any income. In fact, the other way around, it's probably going to chew, or if not dissipate. Dissipate. So as in, let's say for
when
example,
you spend money, when you spend on clothes, personal use.
So that's in a sense, it depreciate and it's gone. So,
but if you are buying clothes for work related, for example, protective gear. Yes, that is kind of a good asset because it's work related.
Example for us would be the business with our shoes. You know, we buy the shoes. It was an asset, and then we sell it on eBay.
It's a stock inventory.
Inventory. So, in a sense, it's it's shoes. It is shoes, but we're going to sell that for a profit.
Yes,
as an example. So that's a good asset. Buy shoes. And then you're going to use it, and it's going to depreciate. Well, over time, it's going to run out. Well, the sole is going to be breaking and make a lot of holes. Smells, and you're going to throw it out. So that's when I guess the bad assets out of it.
When you use it for personal use, it's not work related or generating income or tax deductible, right?
So talk to your accountants in that aspect of it. There's a few things that you can do that, or I guess as a work related expenditure, but definitely have a chat with your accountant. They can I guess clarify a lot more than we do. Depreciating asset. So this is another thing where it's like it's a good and bad depending how you look at it. So let's have an example. A car. Okay.
That's very obvious, right?
Everyone's bound to use a car, or you see it on the road and whatnot. Now it can be a good asset and it can be a bad asset depending how you look at it on the car or the vehicle.
Majority of the people use it for personal use. It's not work related, you can't use it to generate income, then that is a bad asset. Especially
when you just go from A to B, going to work and back. Now,
not even work, it's maybe like personal use.
Personal
shopping.
Use, just going shopping. Now, it can be a good asset because it's a vehicle to get you transport to a certain place where you can generate an income. So in a sense, it's a 50-50 because you need some sort of transportation. Let's say if you can't find a bus, or the bus might be taking, or public transport may take you an hour or two to to do these things,
Yep.
and then while you're doing it,
it saves you time.
Correct. That's what I meant. So you can utilize those time instead of waiting for the bus, working on your side hustle, as an example. And yeah, that's sort of a good and a bad asset.
Yeah, but there's another way of looking cars. What if you can rent it out?
Yeah.
For rental income.
There you go. So we've seen a lot of, I guess, cars around in our neighborhood anyway, where you can actually rent, car next door.
Yes.
So effectively, you rent your car to other strangers just to use for a short term lease, let's say. So the concept of it is, instead of you renting it from a big company, you borrowing it from, I guess, neighbors. Yeah, because it's the location. Sometimes when you rent the car from a big company, you gotta go from, because you don't have a car, so you gotta go from one location to the other location using take another transportation.
Yes, so to get the car and then come back here. So to minimize that, there are a lot of companies just targeting around the area. Yeah. So neighbor.
And then the next one would be, I guess, income producing asset. Now,
like the car. Yeah, like the car, right?
Example with the car alone, it is good because it can generate income producing, I guess, if you rent it out all the time. So another income producing asset would be, let's say, a property, rental property. We have quite a few of those. Well,
producing income, but a lot of people think investment property is good asset no matter what. Even though you are paying a lot, even though you get like $10 tax return.
So that's a little bit more complicated, but I'm trying to generalize it a little bit more. So with, I'd say, property, some people look at it because it's generating an income, like a rental income, let's say. That's a good asset. Now, that can hit you in one or two ways. Yes, it is a good asset if it generates an income and your expenses is lower than the income that is coming in.
Correct.
So owning a property, it can be fun. At the same time, it can be a nightmare. It all depending how the investment set up, let's say.
Give you an example. What if your rental income cannot cover your mortgage or any expenses, all the expenses, I mean, right? So that is bad asset. And what if there's no tenant? That would be a nightmare.
That would be a bad asset.
And now during lockdown and COVID, a lot of apartments or properties are oversupplied in Sydney. So a lot of the tenants are asking rent deduction. So it's hitting hard for landlord.
Yeah, and especially if you still have a mortgage on that particular property, that would mean your repayment's not going to go any lower. No. In fact, some of them is going to go higher if you
we deduct the rent for the tenant.
So that can be a bad asset.
Because you have to work so hard at your job to produce more income, or save up some, cut down your budget or your cost of living to support that property.
So I'll give you a scenario as well, I guess, on a dollar figure with numbers a little bit. Let's say you have the investment property, you purchase them, I don't know, say 500,000 as an example. With the, let's say, a rental income of
$500 a week.
$500 per week. The rental income is 500, but your repayment and the admin cost of the property $600. So it's costing you an extra $100 per week. That is a bad asset.
For us we see bad asset, but some accountant, they don't see it. Accountant will say, oh, you can get your tax return,
tax deduction on this,
depreciation.
So like accountant have different way of thinking.
Because accountant, the job is to minimize your tax.
Correct.
It's
as
not
much as possible.
It's not maximizing your income. It is minimizing your tax.
That's how we see it after doing this for quite some time. So it is up to you to actually differentiate which one is a good asset and a bad asset. They're just going to process on what they have.
Correct. Because we just had a phone call with accounting yesterday, and then she's like, oh, you guys are making more income this year, so you have to pay this tax, and I'm like, yeah, good, I'm making more money, I'm happy to pay tax. And she's like, oh, okay.
So for us, it's not about minimizing tax. Like they do their best to minimize the tax, but if I have to pay tax, it's a good thing for us. We're not trying to avoid it. It's actually the other way around. It shows that I'm actually making money.
Correct.
So it means that you're making a profit, which is a good thing.
Yeah, I think because we've been in the low, that's why now we're happy.
Now, again, in terms of the property loan, it can be a good asset. So we're showing you, I guess, we just mentioned the negative side of the property investing, where it's costing you money. You know, $500 is the maintenance, the income, but in order to keep the property, it's costing you $600.
Yeah.
So that's a bad side of the property. Now, the good side of the property, you want to explain a little bit more?
So your income can cover everything, and you still got some surplus.
That's where we add. So that's the style that we like to do when it comes to property investing. So an example of that would be back to that $500,000 property with $500 income of rental income. But to keep the property, it's only costing you, let's say, $300. You know, whether it's mortgage, maintenance, all of the admin costs, it costs you about $300. So that means you have a surplus income of $200. So that's $200 in your pocket.
Yeah. Oh, you have to pay tax.
Yeah. So that in aspect of it, that's a good asset. I'd rather have this version of the property instead of the other. Yeah,
it's less stressful. Yeah, and you feel a bit more ownership of it.
Yeah,
because you're owning a bigger portion of that property compared to the bank.
That's it. Or it's not just a bank. It would be like, instead of paying someone else's, sometimes when we first started investing, no joke, it's the other way around. We're on the other side where it's actually costing us money. It's like, I'm paying management fee, I'm paying these guys, I'm paying that guys, I'm paying like a lot of people because where's my cut?
Nothing.
Kenny inspects the other way around.
And I pay 100K for that. Everyone's getting a cut without
everyone's getting a cut except me. How come I'm the one that keep on forking it out? This is not property investing. It's supposed to be the other way around. So you got to find a different way of doing things, let's say. I mean, if you want to have a conversation a little bit more in depth, one-on-one, by all means, contact us on the description. And we'll go from there. The last one will be the tangible or intangible asset.
Tangible is something that you can see, just like property or your car. Intangible is things that you cannot see, like our shares.
Micro investing.
The ETFs or shares. All those.
So you invest on something that you don't really see.
You don't hold it.
So when I first have that concept of it, it is kind of scary if you're starting point of it. Because it's not yours. You can't. It's not a piece of gold. It's not tangible because you invested on a big pool of companies. You know what I mean? It's not just one house. You're actually investing in little bits and pieces of lots of different companies out there. And that makes it a bit hard, and it's out of your control as well.
Totally out of your control because you're just an investor. You got no say. You cannot add value. You can't knock on the door. Excuse me, your profit is not that good. Can you please increase it? No, you can't do that. So that can be a good thing. It can be a bad thing as well. So what's the pro? Pro, you don't have to do anything. What do you do? Not much. Like for me, it's like investing on ETF. The thing is, you just have to choose one that suits you. What I like about it is the fact that I'm owning bits of pool out of like 500 companies or whatever it is amount, instead of just investing on one single company. Diversify, ETF compared to. What I like about that is that. And what I like the fact that, you know, if one company decided not make a good performing, let's say, the managed fund able to delete that particular company and replace it to another one. We pay management, let's say, for that aspect of it. Now that's a good thing about it because they're the one that monitor how our the performance it is. Another good thing is they're really liquid. and transparency about the price. You can just buy and sell instantly.
Yeah.
For property
with a click of a finger, click,
Yeah.
you can have your money back in less than a week.
Yes, but property is a long process.
Yeah, property takes like months.
Yeah.
And sometimes there's a cold fee, there's this, they want to change the bits and pieces here and there, the solicitor, there's a lot of moving wheels.
Yeah.
You know, you got to talk to an accountant, solicitor, a real estate agent, the bank, photography.
Yeah.
So
there's a lot anyway.
A lot of different people. The bad side.
Yeah, bad side for investment. You got no say, you got no control.
Yeah, market can dive.
Yeah, market volatility, you can never control it. If you pull out when you're losing money, then you lose your money forever.
And sometimes it can get really, it was like that. On the first time that it dived down, I was like, this is going to be a bit scary.
But I say both shares or ETF with property, they're all long-term investment.
Yeah.
You don't expect to make money with within a short time frame. That's not investment. That's the only advice.
Yeah, from us, we're looking at, in the beginning, we're looking at short-term bursts here and there, and then realize to ourselves, no, we're looking at something that, for us anyway, now our model changed in a sense of we want to see what it looked like in 30 years. Yeah. What does it look like when I'm 60?
30 years, we'll be so old.
70. 60. At least on the retirement bracket.
Yeah.
You know, here we are in Sydney at the current stage is 65. I'm sure it will be 70.
Yeah, when we hit our retirement age.
There you go, 70, 75 maybe. I just want to see what it looked like in about 30 years time. So hopefully this gives you guys an understanding a little bit how we think when it comes to differentiating asset.
Yeah.
Don't forget to subscribe, comment, guys.
See you next time. Bye. Bye.